The hopes and the dreams of the AI rally continuing to power along this market solely rested on the backs of Nvidia's Q2 print, which came out after the bell, sending shares down lower as much as 4% in the after hours. We'll get into their Q2 print, which again looks fantastic from both a top line, a bottom line, and cash flow perspective. More importantly though, we'll get into the Q3 outlook this company provide, again coming in with a raise on the Q3 guidance. We'll also take a look at the data center revenues coming in north of $26.2 billion, once again, yet again higher than the total revenues they posted in their Q1. Now, considering the fact that year over year these numbers look spectacular, consider the fact that quarter over quarter you are seeing some slippage in their key metrics, namely gross margin. As you see, quarter over quarter that is declining. We'll get into some news as it pertains to Nvidia over the past couple of weeks, and then as always we'll get into the technical charts. This one, basically you know what this looks like over the past couple of months as we've been covering Nvidia here on the channel. We'll highlight some levels where it would make sense to maybe step in and pick up some shares, or maybe step out and peel off some of those profits. Hey guys, hope you're doing well out there. It's time to check in with the poster child of the AI rally, and that is Nvidia, a highly anticipated Q2 print finally now in our hands. We'll peel through these numbers, we'll share with you what they really mean as we get along. Now, consider the fact that you get a very minuscule dividend with this company, which again, they've raised nearly 150% over the past basically year. Consider the fact that they also announced a new $50 billion buyback in this most recent quarter, adding to a little bit of a $7 billion buyback that they still have remaining underneath, I think, 2026. Now, Q2 revenues came in at $30 billion, north of $30 billion by just a little bit. That was growth of a casual 122% year over year, beating estimates on Wall Street by a cool $1.3 billion. And consider the fact, guys, the expectations for Nvidia continue to be raised basically every single day, it seems like, but definitely on a quarter over quarter basis, the expectations remain sky high for this company, and yet they continue to come out with beats. Now, the beats are almost expected at this point, as Nvidia, certainly if they came in and matched expectations, that would be disappointing for this company. Also, what we got is a beat on the bottom line, as Q2 non-GAAP EPS came in at 68 cents. Expectations were closer to 64 cents. In terms of the data center, this is by far the largest business of Nvidia at this point, the most important business, coming in at $26.3 billion, up 16%. That is quarter over quarter, and up over 150% year over year. Now look, we're pretty much 1 or 2 quarters away from Nvidia lapping these extremely fast growth rates. So now you can probably expect the growth rates on this data center business, along with their overall revenues, to slightly decline in their growth rate. Certainly they'll still be growing on a year over year basis, but while you might not expect that 150% growth, maybe closer to somewhere around a 70 or 80% growth rates. Now, in fact, the Q3 outlook, which in my opinion is actually more important than their Q2 numbers, revenue for the upcoming Q3 is expected to be at $32.5 billion. Consensus was for $31.75 billion. And consider the fact that that can be moved around plus or minus 2%. So $31.7 billion would have represented right around 75% growth on that top line. Nvidia guiding for around $32.5 billion. Now, the high end on Wall Street was closer to $38 billion. Certainly Nvidia, I don't think, was really expected to come in close to $38 billion, but in my opinion, in all honesty, I think $33 billion was definitely not out of the question. And considering the fact that Nvidia guiding underneath $33 billion is probably why investors are just a little bit disappointed. And consider the fact, it sounds crazy to be disappointed with over 80% revenue growth, but when a stock is up more than 150% year to date, yeah, your expectations are absolutely through the roof. And a $33 billion quarter certainly wasn't out of the question for the upcoming Q3. Now, what I do certainly expect is for Nvidia to come in higher than $33 billion, because what they're known for is raising guidance, but also coming in higher than what their expectations themselves are. So certainly I wouldn't be overly concerned with this $32.5 billion guide. This could also be Nvidia just tamping down expectations a little bit compared to what Wall Street really wants this company to post. And then they come in with a number closer to $33.5 billion. And then maybe for this upcoming Q4, yeah, certainly they won't put up anywhere near $46 billion, but maybe $36 billion certainly isn't out of the question for that upcoming Q4. So consider the fact that while the Q3 outlook still is quite rosy, it's maybe not as high as what Wall Street anticipated. Probably a $33 billion figure for this guide for Nvidia would have, I think, met those bullish expectations that investors have for this company. Now, on top of that, non-GAAP gross margins are expected to come in at 75% for the upcoming quarter. Keep in mind, the most recent Q2, they just posted gross margins of 75.7%. And consider the fact that quarter over quarter, that is a decline of nearly 3.2%. So what they're once again anticipating is a sequential quarter over quarter decline on those non-GAAP gross margins, coming basically underneath 75%. So that is certainly another area where expectations probably do need to be tamped down, and that the gross margins have probably topped out in this Q1 close to 79%, and what we can expect is a mid-70s gross margin range for the upcoming full year. On top of that, operating expenses from a non-GAAP perspective expected to be close to $3 billion, growing somewhere in the mid-30s to 40% range, and then non-GAAP other income expected to be right around $350 million. So really, I think the most important number is the Q3 outlook, which we got for $32.5 billion. Again, higher than what Wall Street anticipated, maybe just not as high as I think what the bullish investors were really hoping for. Now, we once again got that data center revenue figure of $26.2 billion, higher than your Q1 total revenues. We also saw growth on the gaming side. We saw growth on the professional visualization side, along with growth on the auto side and OEM. So this business across the board is growing. The more important figure is the data center number, which continues to just be extremely strong quarter over quarter and even year over year. And like we said, the gross margin flattening out on a quarter over quarter basis, that's something you have to keep in mind as you continue to invest in shares of Nvidia. And look, while we're seeing the growth rates on that revenue and earnings side slip from, not growing 100% or 150%, but instead just growing 70 or 80 or even 60%, keep in mind that is still fantastic growth for the revenues. On top of that, earnings growth expected to once again slow down from 140% growth to maybe 80% or 90%. Keep in mind that is still fantastic growth rates. And while this company has raced up over 150% year to date, you're actually not looking at a crazy valuation, as you're looking at a forward 12-month valuation somewhere around, I'd say, a 40 times a earnings multiple. Again, not egregiously overvalued, certainly not widely undervalued either, but considering the growth that you're probably still going to get with this company for the next 12 months, the valuation I don't think is widely overvalued, and I think something that can still be able to give you market-beating returns, maybe not 100% returns, but still 10 to 20% returns over the next 1 year, I think certainly isn't out of the question for Nvidia. Now, yesterday, Nvidia announced that they released new NIM agent blueprints, which are known as Neural Inference Microservices, basically part of their software services, which are a catalog of pre-trained customizable AI workflows that equip millions of enterprise developers in order for them to build out their own Gen AI applications. And so I think this just expands Nvidia's moat more so on the software side. I think this company certainly doesn't get enough credit on the software side. I think a lot of their talk is on the hardware side, and rightfully so. Look, they make a ton of money selling those GPUs, but I think this company's moat really is also linked to their software side and the advantages they have on that front as well, especially enabling enterprise customers that will likely stay with them for a long time. Now, from Meta's earnings call last month, at the end of July, we got a quote from Mark Zuckerberg saying, "Better spending on AI now rather than too late." And look, that's paraphrased. The exact quote was, "It's hard to predict how this trend will multiply over generations out into the future, but at this point, I'd rather risk building capacity before it is needed rather than if it's too late, given the long lead times for spinning up new infra projects. And as we scale those investments, we're of course going to remain committed to operational efficiencies." Look, we just got this quote from Mark Zuckerberg. We got a similar quote from Sundar Pichai from Google. We heard the same thing from Microsoft. All of these hyperscalers are saying the exact same thing, that it's better to spend on AI now instead of later when it just might be too late. It's better to be overinvested at this point rather than underinvested, because the cost of missing out is probably far greater. And the fact that these are Nvidia's largest customers still saying that they're willing to spend more building out their data centers now just shows me that the spend on AI and data centers will likely continue at least for another 2 to 3 quarters. Really, I don't think Nvidia's revenue expectations come into question until we hear one of these hyperscalers saying that they've built out their AI infrastructure spend and they're likely going to pull back over the next 12 months. I think we're still 2 or 3 quarters away from that happening, but when that does happen, I think that will spook Nvidia investors. Now, what we also got earlier on in August was the Supermicro CEO, which is again one of Nvidia's largest customers, saying that the Blackwell GPU will likely be delayed until early 2025. And look, this sent Nvidia stock down a little bit at the start of August, since has recovered from that statement. But in my honest opinion, like we just heard from these hyperscalers like Meta, Microsoft, and Google, the spend is still out there for AI infrastructure. They certainly do have enough money to continue to spend on the data center build out. And really, I think Blackwell is, again, another GPU that they will likely have more demand than supply once it does come out. And so certainly maybe a 1, 2, or even 3-month delay, I don't think is overly concerning for Nvidia. I do have confidence that if there is that gap in Blackwell supply, I think this company will be able to manage it quite well. And in the meantime, I think expectations, or at least demand, for their existing H100s will remain pretty sky high. In terms of the financials, it continues to look absolutely stellar. We got that revenue figure north of $30 billion. Cost of revenues, again, coming in at $7.5 billion, is higher pretty substantially year over year. But yeah, just consider the fact that you've more than doubled your revenues. And so your gross profits come in north of $22.5 billion. Last year, you were underneath $9.5 billion. That is a huge expansion year over year on those gross profits. Operating expenses being held relatively in check. Your R&D is up nearly 50% year over year. Sales, G&A also being relatively higher, up to $850 million. But again, $850 million for nearly $30 billion of revenue, not a whole lot of SG&A over at Nvidia. And so your operating expenses come in at $4 billion. You take that off of your gross profit and you're left with nearly $18.5 billion in operating expenses. For the last 6 months, you're on a similar run rate, nearly $35.5 billion of operating income. Again, year over year, this company can't even be compared simply because it doesn't seem like it's the same company. A year ago, you were printing just $6.8 billion in operating income. On top of that, they have more cash on their balance sheet, earning them more interest in this still relatively high interest rate environment. And we get to net income of nearly $16.5 billion. Last year, we were just a shade over $6 billion. Again, year over year, fantastic results. Probably won't look this rosy in the upcoming quarter, considering the fact that we're going to be lapping the period of very fast growth, but still will look phenomenal with nearly 70% revenue growth. On top of that, they are buying back shares. As you see, your diluted shares outstanding did decline year over year. They also announced that $50 billion buyback, which probably should help, again, with some dilution, but also reducing those shares outstanding. Cash and cash equivalents coming at nearly $35 billion. This is on a 6-month basis. 6 months ago, we were nearly at $26 billion in cash and equivalents. Of receivables coming in higher by nearly $14.1 billion. On top of that, inventories, they are beginning to pile up just a little bit at $6.6 billion. Last 6 months ago, we were at nearly $5.2 billion in terms of inventory. So some of this could just be getting more in line with demand expectations. Look, $6.6 billion worth of inventory for a company that's doing more than $30 billion a quarter, certainly nothing to be overly concerned about. If you do expect this company to see a slowdown in terms of demand at one point or another, yeah, this inventory number will certainly show that, as you'll probably see a pretty big uptick in those inventories. In terms of liabilities, nothing to be overly concerned about. They paid off their $1.2 billion in short-term debt, and then total long-term debt sitting right around $8.5 billion. Again, basically pocket change over at this company at this point. In terms of cash flows, nearly $16.5 billion in terms of net income over the last 3 months is what we pull down. We get to add back some stock-based comp and some depreciation. We have $14.5 billion in operating cash flows. Again, that's for 3 months. That's not for the full year. That is for 3 months. And consider the fact for the 6-month period, they've posted nearly $30 billion in operating cash flows. Gives them just a ton of room to sort of move around that cash in order to return to you, the shareholder. And so they spend nearly $3 billion in terms of investing activities, but then spend nearly $7 billion buying back their common stock, paying off that short-term debt, and then they also paid out a little bit in terms of dividends. You can also expect this company to be a very fast dividend grower for probably a long time to come. And so while the dividend certainly at this point is insignificant, yeah, if you hold shares of Nvidia over a long time, 5-10 years, yeah, that dividend growth will certainly be beneficial for you over that stretch. In terms of the technicals, look, we've been in a very predictable pattern of higher highs and higher lows for more than a year now, and shares of Nvidia continuing to stay within this channel, coming down just around 4% in the after hours, coming down to $120 and some change. Look, 4% decline, not huge, especially for the results that we got. I think the expectations were certainly a bit too high for this company, and they did come in and basically right around meet them, if not slightly miss them in terms of the Q3 outlook. I think this company, no doubt, is still a well-oiled machine with a ton of demand for their core products. I think this company can continue to be a cornerstone in your portfolio. Certainly, you don't need to freak out at this point. If you are holding shares of Nvidia, I think you can continue to hold them. In terms of a buying opportunity, your first level is probably if shares come down closer to the bottom end of this channel, probably closer to $112, $110 a share. That is probably the first level where you can maybe look to pull the trigger once again on shares of Nvidia. And then in terms of taking profits, I think certainly there's no harm in taking profits as this company continues to move higher. Certainly as it gets closer to the top end of this range, that is probably a point where you can look to begin to take some profits. In the meantime, I think you can continue to hold shares of Nvidia. There's nothing in this print that told me otherwise. The expectations remain high for this company, yet they continue to blow those out of the water. And I think for the next couple of quarters, they'll continue to do that, considering we got all the hyperscalers to say they're willing to spend more on data centers for the upcoming year than they did over the previous 12 months. That was my take on shares of Nvidia Corporation, down nearly 4.5% on the heels of their Q2 print, which again was fantastic. I don't think there's anything to really be concerned about. While this company isn't dirt cheap anymore and you probably aren't seeing another 100% rally, I think you can still, believe it or not, continue to outperform the indexes, outperform the market, and maybe see another 10 to 20% upside over the next year in shares of Nvidia. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.